Welcome to the 10 lesson of Chapter 6. Today, we embark on a journey to understand the stop-out level in Forex trading. In the world of Forex, risk management and account preservation are of paramount importance. One tool that can help us in this endeavor is the stop-out level. Imagine you're on a boat in the middle of the ocean. Your stop-out level is like a life jacket. It's there to save you when the sea gets rough and your boat is at risk of sinking. In the context of Forex trading, the sea is the market and your boat is your trading account. If the market turns against you, the stop-out level can be the difference between sinking and staying afloat. In this video, we're going to delve into the concept of the stop-out level, what it is, why it's important, and how it works. We will start by defining the stop-out level. Simply put, it's a specific margin level at which a broker will start closing your positions, usually starting with the least profitable ones to prevent further account losses. It's like your life jacket inflating automatically when you start to sink. Next, we will highlight the differences between the stop-out level and the margin call level. While both are safety nets, there are crucial distinctions to be aware of. A margin call is like a warning signal, your life jacket's whistle blowing to alert you of danger. The stop-out level, on the other hand, is a more severe action, akin to your life jacket inflating to save you from sinking. We will also provide illustrative examples of how these levels function in real trading situations. This will give you a clear, practical understanding of these concepts and how they can impact your trading. By the end of this video, you will have a comprehensive understanding of the stop-out level and how to manage it effectively in your trading. So, buckle up and let's set sail on this educational journey. Let's begin by defining what the stop-out level is. In the world of Forex trading, the term stop-out level may sound complex, but it's actually a straightforward concept. Essentially, the stop-out level is a safety net put in place by your broker to safeguard your trading account from going into a negative balance. So how does it work? Well, when you're trading in the Forex market, you're essentially borrowing capital from your broker to open positions. This borrowed capital is known as margin. Now imagine you've opened several positions and the market isn't going your way. Your trades start to lose money and your account equity begins to dwindle. This is where the stop-out level comes into play. The stop-out level is a specific margin level set by your broker. When your account equity drops to this level, your broker will start to close your open positions. This is done to prevent your account from incurring further losses. The broker will usually start with your least profitable positions. Now you might be wondering why your broker would do this. After all, isn't it in their best interest for you to keep trading? Well, in a way, it is. But your broker also has a responsibility to protect you from losing more money than you have in your account. Remember, when you're trading on margin, you're essentially borrowing money. If your losses exceed your account balance, you could end up owing your broker money. That's a situation both you and your broker want to avoid. The stop-out level serves as a kind of last resort. It's a mechanism designed to preserve your remaining account balance and prevent it from sliding into the red. It's like a safety net, catching you before you fall too far. But it's important to remember that the stop-out level isn't a magic bullet. It won't stop you from losing money on your trades. What it will do, however, is limit your losses to the amount of money you have in your account. So while it won't make you a better trader, it can help you to manage your risks more effectively. In essence, understanding the stop-out level is like knowing the depth of the pool before you dive in. It's a measure of how far you can go before you hit bottom. And it's a crucial tool for managing risk and preserving your account balance in the volatile world of Forex trading. Understanding the stop-out level is crucial to prevent unnecessary losses and keep your account healthy. Now that we know what the stop-out level is, let's differentiate it from the margin call level. To begin, both the stop-out level and the margin call level are important mechanisms in Forex trading that act as safety nets to protect traders from severe financial losses. However, they are not the same, and understanding their differences is crucial to successful trading. Imagine a tightrope walker performing high above the ground. The margin call level is like a safety net positioned a few feet below, ready to catch the performer if they lose balance. On the other hand, the stop-out level is the ground itself. If the performer falls all the way to the ground, it's a more severe consequence than being caught by the safety net. In the realm of Forex trading, the margin call level serves as a warning signal. It alerts traders when their account equity is close to the necessary margin for holding open positions. At this point, traders have the opportunity to either deposit more funds to meet the margin requirements or close some positions voluntarily to lower the margin. This is akin to the safety net catching the tightrope walker, giving them a chance to regain balance. In contrast, the stop-out level is a more drastic measure. When a trader's account equity falls to the stop-out level, the broker will start closing positions, usually starting with the least profitable ones to prevent further account losses. This is the equivalent of the tightrope walker hitting the ground. At this stage, the broker takes control to prevent further damage. Let's take an example. Suppose a broker has a margin call level of 40% and a stop-out level of 20%. If a trader's account equity falls to 40% of the used margin, they will receive a margin call. This is the trader's opportunity to act. They can add more funds or close some positions to increase their account equity. However, if the trader does not take action and their account equity continues to fall, reaching 20% of the used margin, the broker will step in. The broker will start closing positions, starting with the least profitable ones, to prevent further losses. This is the stop-out level in action. In essence, while both the margin call and stop-out levels are designed to protect traders from significant losses, they serve different functions. The margin call level is an early warning system, allowing traders the chance to take corrective action. The stop-out level, on the other hand, is a last line of defense, activated when the trader's account equity falls dangerously low. Knowing the difference between these two can help you make informed decisions and protect your investments. So remember, keep your balance on the tightrope of Forex trading, and these safety nets will be there to catch you if you stumble. Let's delve deeper into how these levels function in real trading situations. Imagine you're a trader who has just opened a Forex account with a broker. Your broker has set a margin call level at 50% and a stop-out level at 20%. This means that if your margin level drops to 50%, you'll receive a margin call warning. If it further drops to 20%, the broker will initiate a stop-out, closing your least profitable positions to prevent further account losses. Let's say you've deposited $1,000 into your account and you're using a leverage of 1 to 100. This gives you a total trading power of $100,000. Now, you decide to buy a certain currency pair, and the required margin for this transaction is $500. So, your margin level is now at 200%. However, the market moves against your position, causing your equity to drop to $600. Your margin level is now at 120%. Even though your equity has decreased, you're still safe from a margin call because your margin level is above the broker's margin call level of 50%. But then, the market continues to move against you and your equity drops to $300. Your margin level has now dropped to 60%. This triggers a margin call from your broker, warning you that your account is at risk. At this stage, you can either deposit more funds into your account, close some positions to reduce your margin, or hope that the market will turn in your favor. Unfortunately, the market continues its downward trend, and your equity drops to $200. Your margin level is now at 40%. Even though you're already below the margin call level, your broker hasn't closed any of your positions yet. Finally, your equity drops to $100. Your margin level is now at 20%, reaching the stop-out level. To prevent further account losses, your broker initiates a stop-out. They start closing your positions, beginning with the least profitable ones, until your margin level is back above the stop-out level. In another scenario, let's say your broker has a stop-out level set at 100%. This means that as soon as your margin level drops to 100%, your broker will start closing your positions. This kind of setting is usually found in brokers that offer high leverage or cater to aggressive trading strategies. In this case, you don't receive a margin call warning. As soon as your equity equals your used margin, your broker initiates a stop-out. They will close your positions starting with the least profitable ones until your margin level is back above the stop-out level. This setting is more stringent, but it protects you from losing more than what you have in your account. These examples should give you a clear idea of how these levels work in real-life trading. Understanding margin call and stop-out levels is crucial for managing risks in Forex trading. It helps you to safeguard your account from severe losses and to trade in a more disciplined and systematic way. We've covered a lot today. Let's quickly recap. Our journey today has been centered around the concept of the stop-out level in Forex trading. We've navigated through the depths of this crucial aspect of trading, shedding light on its definition, its significance, and how it differs from the margin call level. We started off by defining the stop-out level, It's a specific margin level, a point at which a broker will begin closing a trader's positions to prevent further account losses. Usually the least profitable positions are the first to go. The stop-out level serves as a safety net for traders, aiming to preserve their accounts from being completely drained. Then we moved on to distinguish between the stop-out level and the margin call level. While they both serve as safety nets, they have some key differences. A margin call is like a yellow light, a caution sign signaling that your account margin is low and you need to either reduce your open positions or deposit more funds. However, the stop-out level is the red light. It's a more severe action taken when the account margin falls below a certain level. But we didn't just stick to theory, did we? We dove into some real-world illustrative examples of how margin calls and stop-out levels function in actual trading situations. This helped us see how these safety nets work in practice, providing a clearer picture of their roles in the complex world of Forex trading. The stop-out level is not just a term or a concept, it's a tool, a mechanism designed to help you manage your risk in the volatile Forex market. Understanding and managing this level is vital for maintaining account longevity and achieving trading success. It's like the safety harness that prevents you from falling off the trading cliff when things don't go as planned. And remember, while the stop-out level can help save your account from a total wipeout, it's important to have sound risk management strategies in place. It's always better to prevent a situation where you're at the mercy of a stop-out level. As they say, prevention is better than cure. As we wrap up this lesson, let's keep in mind that learning is a continuous process. Each lesson takes us a step closer to becoming more informed, more proficient traders. And with each step, we're better equipped to navigate the unpredictable waves of the Forex market. Thank you for completing this lesson. We encourage you to start the next lesson. Trading scenario with a single margin threshold. Margin call level at 100%. Stay tuned and keep learning.